Okay, well thank you very much for the chance to be here, to go first, to try to live up to everything Glenn just promised. This is joint work with David Atkin, who's at MIT. So this paper is focused on the applied topic in the field of international trade and development economics, concerned with questions of globalization, that is kind of reductions in trade barriers between countries, but it starts with an observation that motivated us when David and I were in grad school and traveling around India. We were interested in the questions of what globalization did to India, and it was a kind of common refrain that if you were in a remote part of India and you ask people, well, what did the 1991 immense tariff reductions, liberalization, globalization, what impact does that have on your life? And the typical refrain was, we haven't really seen it yet. We're kind of so remote that globalization hasn't really happened here yet, and that stuck with us, and so we decided to try to explore that in a different setting where the data was better. We tried to do this in India, but the data wasn't suitable, which was some sub-Saharan African countries. So the question is sort of if you're in a relatively remote part of sub-Saharan Africa, how close are you to other places in an economic sense? And so that motivated this exercise. So in particular, what we're going to try to look at is first of all, just simple kind of an attempt at measurement. These intranational trade barriers that you might imagine in a country like, say, Nigeria, might exist between where you live in, say, a remote part of Nigeria and a port city or a major factory producing city. And those are the things we're going to call intranational trade costs. And it's fair to say that for reasons I'll go into, the literature doesn't know a lot about this, the magnitude of those costs. You sometimes hear that a place like Nigeria, the roads are so bad that it's just sort of cripplingly impossible to get goods to and from remote locations. And we're going to try to explore that. And to set the benchmark, we're going to do a completely analogous exercise with US data to sort of try to compare them. A related question, though, is sort of, which is more tentative, requires stronger assumptions, is about, but it is related, is sort of the notion of the incidence of globalization. So that is, if there were a global price change, that is a price change at the border or at the port, if you were to reduce your international trade costs, such as tariffs, what would be the incidence of that change, that kind of gain in a sense, onto people within, say, Nigeria, different types of people, producers, consumers, remote and proximate to the border. Okay, so just this sort of fixed idea is the way we'll be looking at this is with prices, and I suppose that's why we're on the program, because this is a very simple piece of economic theory. It's you could call it an identity, but it's one that that is kind of being the bedrock of work on this question of trying to measure trade costs. So I'm going to just sort of explain it very briefly. I'm using notation here where there's a region that's an origin, and there's another region that's a destination. And so that's the O and the D there. And this thing I'm calling tau of X OD is some notion of the thing we're trying to measure, the cost of getting goods from O to D. And in fact, we're going to not even try to measure those costs. We're going to try to just ask how they respond to cost shifters. That is that derivative. Now, in a sense, that's the policy question of interest here. If you were to build a road, if you were to improve the X's between some city and some village in Nigeria, what would be the reduction in tau? That's that derivative, of course. And so, what this simple kind of identity tells us is that if you were to see the price at which the good kind of were for sale in some location O, close to the origin where the good is made, and then also the price of the same good elsewhere at some destination where the price is being consumed and you see it being consumed. If you were to see those two prices, you could try to take a stab at measuring this cost. But of course, this thing, mu, the markup, would make that life difficult in an environment of imperfect competition. But that's the goal, in a sense, is to use prices to try to measure those intranational trade costs. Okay, so the first challenge that's kind of made this hard to do is just a lack of data. So the first thing we did was try to find countries where we could overcome that challenge. So of course you wouldn't want to do this if you thought that the thing you were observing in O and D, of course what we're going to really do is it's a one O and many Ds in order to try to run that as a regression in a sense and estimate the function tau of X across lots of different X's, is you would want to make sure that's the same product, or as close as possible that we can get to that. So that was, just a data exercise. We just went out and tried to find something like barcode level product descriptions for products in some sub-Saharan African countries. Of course, doing that in the US was easy thanks to the Kilt's booth marketing initiative. But doing it in Nigeria and Ethiopia was not easy, but we were able to find countries where it was feasible. The second thing is a little more subtle, which is, but relates to how this has been done in the past, and again relates to price theory. Is a typical assumption when this has been applied is to assume that markup there is zero. The markup in my previous equation. So let's just imagine we have perfect competition, markups are zero, or coolly they're the same everywhere, so they won't affect your inference of that slope. A more subtle problem that's impeded work on this is just you don't know, you typically have a data set with the price of, say, a given barcode at all locations in Nigeria, but you don't know where they come, you don't know how to rank the locations into O's and D's. And they just appear anonymously as what you might think of as I's and J's. And there, price theory really just tells us that there's an arbitrage relation that should hold. That whatever complicated high-dimensional stuff pins down the price in I and pins down the price in J to randomly chosen locations in a world of arbitrage, and this perfect competition assumption should obey this inequality that helps put a bit of a trivial bound on these taus, but not that helpful one. So the second thing we did with the paper was just sort of say, well, we can't do this until we go out and find out where these barcodes are made. That was a very simple thing to observe, but surprisingly it hadn't been prominently done in a widespread effort before. So in those cases where you believe in perfect competition and know how to order the locations I's and J's into a special pairs that are always origins and destinations, then this becomes very simple, very powerful piece of price theory, admittedly under very strong assumptions, where those price gaps between origins and destinations identify the thing of interest. So now that obviously is powerful. To me, it's always attractive because all the complexities of the economy on the supply side and demand side pin down PO and pin down PD, but all that stuff is doesn't matter for the question of interest, admittedly under this perfect competition assumption. But all that complexity doesn't matter for the question of interest if the question of interest is just measuring tau. So I think that fits very well with the introduction that Glenn gave. Okay, but so just to give you a picture of what that would look like in our data, and this is a bit of a preview of results, but I wanted to just so you see where this is going. Here are 3 countries: Ethiopia, Nigeria, US. These are results of pool across all our products, all our location, all our years, and estimate non-parametric regressions of, in a sense, that tau function against just the simplest possible x you can imagine, which is just distance from one location to another. And starting with the green dashed line, that's the scatter you would see, again, normalized to go through 0 at the closest location, which is going to be that normalized to be there. This is what you would see, a kind of a slow price rise between any location I and any location J, if you take the absolute value of the price gap, which is what's typically being done. So a slow price rise in Ethiopia, a relatively slow price rise in Nigeria, and also a slow price rise in the US. And so, somewhat against my priors, we saw this, you see roughly the same price rise in Nigeria as the US. These are very similar products, they're kind of consumer products in both countries, lightweight consumer products, similar value, but I would have expected a much steeper price slope in Nigeria. Now, if you do what theory should tell you to do, it's just that is don't use this inequality everywhere, instead restrict to the ones where the equality binds, again this requires perfect competition, which I'll relax in a second, then you get something that looks a little more sensible, which is that then you get the blue line, we call the trading pairs, and this blue line is steeper considerably steeper for Ethiopia and Nigeria than it is in the US. That was consistent with what I expected when I started working on this project. Similar in Ethiopia and Nigeria, you might think that might make rough sense. Although kind of a little puzzlingly, it's actually negative in the US. That's suggesting that if we're estimating a cost, the cost is actually falling, and that sounded puzzling to us. So of course, this suggests the very obvious possibility that it might be that when you're measuring how prices change, so these would always be origin. When we look at the blue lines, this is always asking as you leave kind of a factory town or a port town, does the price rise? And this tells you on average the answer for Ethiopia is yes, and Nigeria is yes, but for the US the answer is kind of no. And of course prices don't have to reflect marginal costs, they could reflect market power as well. And so this might be telling us that market power is changing. So the final goal of the paper is to try to say, well, what can we do about this markup term here? And that's where a sufficient statistic argument is going to help. Again, price data and a little bit of price theory is going to help. This is going to be a very simple oligopoly model in which we can make these statements precise. But in a sense, the derivative you want to know is this, d tau dx. Remember, that's the question of interest. How does distance impede tau? The observable you have in the data is how the price gap changes with X. That's the kind of the moment of interest. But a central problem, of course, it might be that as the costs are changing here, as you imagine the true cost is rising here, you don't know how much of that true cost is being passed through to consumers as you go into the heart of Ethiopia or the heart of Nigeria or the heart of the US, away from factory towns. But whatever that true cost. So of course, this is the price slope. The thing we're interested in is the marginal cost slope. The marginal cost slope might be shallower or steeper. You wouldn't know, but whatever it is, it relates to pass-through, of course, because the key concept is just whether that marginal cost shock that's rising in distance is getting passed, fully through to consumers, in which case the price slope would reveal the marginal cost slope, or less than fully through, or more than fully through to consumers. So that's a simple sense of where this is going. We're going to sort of try to measure that pass-through from some other moment in the data, and then use that to try to correct these slopes. And when we do that, we get something that we think looks a little more sensible, which is that the Ethiopia and Nigeria lines are now even steeper. The US line is now relatively well behaved. It's almost always upward sloping, as you might expect a cost of distance to do. And something relatively sensible obtained, which is that the Ethiopia and Nigeria numbers are similar and both considerably bigger than the US number. Although this surprised us, there's only about 4 times bigger for Ethiopia and Nigeria than it is for the US. That I think is contrary to many people's expectations about this environment, but it turns out that there have been a couple engineering studies where they've tried to actually measure the cost of sending a truck down some roads in regions of East Africa, admittedly not Ethiopia, and admittedly parts of West Africa, admittedly not Nigeria, but you might imagine these things are in the ballpark, and the US. And those are also in the same rough ratio of kind of 4 to 1. So it's sort of, maybe it does pass a bit of a smell check. Okay, so that's where this is all headed. The final thing we're going to comment on is this incidence question, which is that you might imagine everything there is just purely kind of costs. So that if you believe this number, it would tell you that that these remote consumers in Ethiopia pay that much more. That number there is about 10 cents for a typical product that costs sort of 60 cents. So they pay that much more for their goods. They pay this much more for their goods. That's the price slope. But the cost of getting goods to them is this much more. So that's, in a sense, that's sort of the planners, the thing that will be interesting to the planners to know the marginal cost of getting to those consumers. That would be the blue slope. But a different question is sort of, if there were, that's the incidence question of globalization, if there were a price change at the border, how much would these remote consumers enjoy or not enjoy of the share of that surplus? And that's where, again, pass-through is useful. We're drawing on the work of Glenn and Michael Feibinger, that this pass-through object, if you think you've estimated it well, then it provides a kind of, in simple models, it provides an opportunity to try to sort of partition the incidence of a change. And so an application of that idea is to the change of the cost at the border, the change of globalization. And so the rough finding, that requires stronger assumptions than everything I've told you before. It's going to require one more assumption, but so take it with an additional grain of salt. But the punchline is that in all 3 of these places, we find evidence that we think that the incidence is kind of increasingly pro-consumer as you get to remote places, and that's consistent with there being less entry, a smaller market in remote places, hence less entry, and hence more pro-consumer, pro-producer distribution of the incidence of a globalization shock. Okay, so that's kind of my attempt at a rough introduction, so you know where all this is going. And now let me try to give you some of the details. So I'll first talk about the data, and then this kind of very simple model we think is useful for thinking about this problem that leads to an estimation strategy that's going to build up to those estimates I just told you. And then finally some first estimates of that, those slopes I showed you, and then finally some estimates of this incidence question, the second thing I already showed you. Okay, so on the data, the key thing here is just that one needs to find data on the retail prices. You could do this with different types of prices, but retail prices are the easiest to get. For many identical, or hopefully as identical as possible, products, but crucially across many locations within your country of interest. And then also, the identification strategy we're going to draw on also requires both that cross-sectional information, but also some time series information, so we need that too. And then finally, we need to know the source location, which will be either the factory where the thing is made in, say, Nigeria, or the port through which it enters Nigeria from some foreign country. Okay, so we set out on an attempt to find sub-Saharan African countries for which that was possible. You know, a little bit disappointingly, we only found 2 in the amount of time we allocated to this. But you know, I think this is the kind of data that so this is the data we found with these 2 countries, Ethiopia and Nigeria. It's kind of data that it underpins the CPI of sort of any country. And the key obstacle was just would the people who collect the CPI be willing to share the data with us, and these 2 countries were. So we're roughly 10 years of data for those countries, roughly 15 products in the order of tens to hundreds of towns, like market locations at which they record the CPI, the price of these things. So a central barrier for us was finding products that sort of, you know, fit our requirements, that they were like as narrowly defined as a barcode would be. So these are not, they don't use scanner devices, they don't actually read the barcode for these products. But their instructions to CPI enumerators in these countries is to sort of find this exact product, and those exact product descriptions are meant to be as accurate as a barcode. And you know, the instruction is find that product, don't find something close, find that or give up. You know, and that's the spirit of a barcode kind of data set. So we're going to compare this with the US and draw on the Nielsen home scan data that I already alluded to. Okay, so the second data requirement was these source locations. This was just a simple matter of a telephone survey with a follow-up of firms that make these products. 15 products in Ethiopia, 18 products in Nigeria. Simple telephone survey to the manufacturers of those products, with the importers of those products, and also corroborated with market traders to check that they agreed on what the firms had told us, and then phone surveys in the US to the makers of certain barcodes. And to simply ask them where is the factory or factories at which, or port of import, in the case of imported goods, at which these goods come from. So in other words, if you're consuming a particular type of cigarette in Nigeria, where does it come from at the end of the day? And so this is what they told us. So here's Ethiopia. The blue dots are the market locations at which the CPI every month observes the price of, say, a certain type of cigarette. 100 roughly locations. By the way, you should think of these not quite as villages, more like towns of at least 1,000 people. And the purple triangles are these like source locations for the 15 products in Ethiopia. So no surprise, most of them are produced in the capital, the main manufacturing hub. But there's a bit of scattering around that allows us to do additional things econometrically that I'll get to in a second. This is Nigeria. It's kind of similar with fewer locations. They only do this in state capitals. In their CPI, they don't have a rural CPI in Nigeria, and much more concentration in Lagos of the products produced, but not quite perfect concentration. The US, of course, we're going to be using zip codes as our markets, which the Nielsen consumers are known to be living. So they're kind of everywhere. Sorry, not zip codes, we're using counties. There's roughly 3,000 blue dots behind here that I didn't want to bore you with. And then these manufacturing towns for these leading barcodes that are kind of scattered throughout the US. And of course, roads are shown in all these pictures because we're going to do some things later that project some of the X's onto things like roads, high quality, low quality roads. Of course, good quality roads in the US are just everywhere. Okay, so just to finally give you a sense of the products, you should be thinking of like fairly low weight, also low value consumer products with a median price in the range of kind of between 50 cents and $1, depending on the country. Similar standard deviation across the countries. These are things like particular types of soap, particular types of cigarettes, particular types of beer, particular types of toothbrushes, whatever, that kind of stuff. Okay, so I'm gonna now turn to sort of this the way we're kind of using a bit of simple theory to sort of think about the estimation exercise here.
Please. How does distribution work in the US for these products? I mean, is it really sent from the factory to the cities, or is it going to some distributor that's really sitting somewhere else? And so, I mean,
of course, that's a good point. We don't have hard data on that. We didn't try to gather such data. As you know, it would be hard or difficult. But our sense for what it's worth in Nigeria and Ethiopia is that's not going on. That was explicitly a question we asked these producers. and they were willing to answer it. In the US, they weren't in a sense. But the just in fairness of what you're going to see, everything's going to be pretty, extremely partial equilibrium, extremely kind of short run in a sense. So you should be thinking as sort of almost like what's the cost of distance holding stuff like that constant. So of course a more general equilibrium exercise might allow for the fact that the growth of one region of a country allows us to put a hub there, which completely changes the towers everywhere. That'd be a fascinating thing to look at. We're not looking at that. We're looking at things that are, you might imagine, just sort of fixed network. So it's like we're estimating this tau function that in a very reduced form way might capture some of that.
Actually,
Please,
well,
yeah.
aren't you're estimating the equilibrium network and topology of the network.
Precisely. This current, like the current equilibrium. Yeah.
Right. So you are incorporating all of that. They have the option to do the shipping in a linear way, and instead they're doing it in whatever way they are.
That was the spirit of what I meant. You're right. Absolutely.
And in some ways.
But it might change. I mean, as I meant, some counterfactual might change that equilibrium, and that's not something something I'm studying. So imagine just a single product. I told you, very partial equilibrium. A single product at a single destination D. So it's coming from a location O where it just happens to be made in this equilibrium to some destination D. And that origin location could be a port or a factory, as I've already sort of implied. So the idea here is just very simple. Imagine that in location D, the people who are selling the good in D face a particular demand curve. So far you could just imagine it takes whatever form you want. And then there are, and this is consistent with facts on the ground in Ethiopia and Nigeria, according to our surveys, the factory that makes the good in location O sort of hands it off in location O to intermediaries, who are distributing firms and transportation firms and traders, etc., who, in a sense, just their job is just to get the good to the consumers in location D. And of course, we know, we're fully aware that in the real world, that probably involves a long step of, probably non-vertically integrated different types of players, shipment firms, distribution firms, wholesale firms, finally retailers. And so, but unfortunately we don't have any data on any of those prices along the way. We unfortunately, everything here just comes from the CPI, it's just retail price data, it's the final price that the consumers see. So everything I'm just asking you to imagine is kind of an as-if intermediary sector that's doing the job of getting the good from O to D. So the assumption we're going to start with is that those intermediaries, they're all symmetric, but and all have constant marginal costs. So this is kind of the simplest oligopoly model you can imagine. Of course, their marginal cost, just to keep track of the obvious here, is both that they have to buy the good in O. So their marginal cost is this entire square bracket here, but that has two parts. One is that they have to buy the good from the factory in location O, and then they have to ship it to D, and that tau of X is the thing we're interested in recovering. So the idea is we just need some notion in which the way they interact is stable. A common way to model that, of course, going back a long way, is with some notion of a conduct parameter. We're also assuming that in the short run at least, that the number of players, these symmetric players in a given market for a given product is fixed. So that means that everything can be summarized by this kind of competitiveness ratio of the number of players to the sort of the conduct parameter. So the key insight here is that, of course, if you just take the first order condition, it looks like the thing I showed you before, the price gaps equal tau plus the markup. And then you can ask, well, how does the thing we see in the data, that is how the price gaps change with X, relate to the thing you wish you could see, which is how the taus change with X. Right? That's of course, the identification question. And it changes it, there's three reasons that they're different. The first is the one I mentioned in the introduction, which is just that even if all these locations were identical, the oligopolist might choose, as you go into the heart of Nigeria, your costs are higher, and you might pass through, that cost, less than fully or more than fully, and that's all summarized in this term here. This is kind of a pass-through term. But there's, of course, other reasons that the price gap might not reflect just purely the cost change, such as, for example, the competitiveness environment is changing as you go into the heart of the country, or the taste, the demand curve is just different as you go into the heart of the country. And we're going to try to, with design empirical strategies to kind of measure this so as to undo that and sort of treat that as effectively unobservable. That's where Passer is going to come in, and then use some theory to sort of help us develop control function strategies for these guys. But the key problem here is the data we have is just price data and X's. We don't have data on demand and quantities and the kinds of things that you'd love to have. Okay, so this summarizes what I just said. So to make kind of further progress, everything I just said was kind of, identification of, heuristic identification argument based on general functional forms. A useful particular functional form for seeing this kind of through to the data is one in which pass-through is constant. So the constant pass-through demand class, which of course Bühler and Fleiderer characterized as looking like this. This is the inverse. If you want the pass-through rate to be constant in a model like this, then that is constant, no matter what are the costs of all the players, the pass-through rate will always be the same. Then your inverse demand curve in this partial equilibrium model needs to look like this. And of course, the nice feature for us from that perspective is it's relatively flexible. Of course, it's as flexible as possible, subject to constraint to pass-through is constant. That's an attractive empirical property because we're going to try to estimate pass-through, and of course, we're going to try to do that as flexibly as possible, but we didn't want pass-through to be a moving target. We wanted something where pass-through itself was something one could try to just estimate as a parameter. Okay, so note the pass-through, however, the pass-through rate, often denoted rho, is some mixture of this demand parameter, the kind of curvature of the demand curve, but also the competitiveness of the environment. That's summarized by that phi thing I mentioned earlier. So under perfect competition, any demand curve would have pass-through equal to 1. The phi would go to infinity. But away from that, anything outside perfect competition, there's a mixture of demand and supply that determines pass-through. But whatever it is, that mixture is summarized in the pass-through rate, and that's the sufficient statistic argument. Okay, so if you kind of stick that in that functional form assumption into our model, you get two useful empirical equations, we think. One looks like this, which just says that, well, let me jump to this one first. This is the useful one for us. Remember, we're interested in tau of x. Now, what this equation says is that if you happen to know pass-through, if you knew the pass-through rate for a given product in a given destination market, for cigarettes in some village in Nigeria, that would be denoted rho KD with a hat on it. Imagine you knew it. So the argument here is that kind of if you did know it, then you should not be using the price gap, which is sort of PD minus PO, but you should instead be using what we think of as kind of a pass-through adjusted price gap, which is this function here, that as you can kind of see is just sort of PD minus PO, but the PD you have needs to be adjusted for the pass-through rate. That's all that's going on in that simple expression there. So it's kind of saying if you knew the pass-through rate, then you could adjust the price gap to kind of undo this kind of imperfect pass-through along as you march away from Lagos in Nigeria, such that that slope in the data now does identify tau of x. With the exception of this stuff here, which is the possibility that the demand curve you're facing is just different in each of these locations. But there's another kind of useful piece of theory here, which is that, of course, in general, we know that there's two types of confounders, one to do with demand and one to do with the competitiveness environment. But pass-through is again playing a nice sufficient statistic role here because it's summarizing that competitiveness environment. Whatever that is changing over space should be revealed by the extent to which the pass-through rate is changing over space in this constant pass-through Bühler-Fleiderer system. So that's all summarized here. It sort of says that this weird mixture of an unobservable, that's the position of the demand curve locally, and an observable, the pass-through rate, in every location. This weird mixture of observables and unobservables is the thing you want to try to control for. So obviously we don't observe this A, that's going to act like an error term for us. We're going to try to stick in a rich set of fixed effects that we think would do the bulk of the work on accounting for how demand might be varying over the country. Of course, the fact that we have many products in many locations in many years helps with that kind of strategy. But an important piece of the theory tells you whatever you're doing to deal with that, the theory wants you to interact with this sort of function of pass-through rate to control for the competitiveness that might also be changing throughout the country. And effectively, the intuition we're going to try to exploit is that if there were shocks to the origin price of this product, particular product in some particular year, then you could try to estimate the correlation between how that origin price shock and the destination price shock. And this structural equation in the model tells you that correlation is confounded by these confounders. But again, there's a kind of a sense in which it speaks to the types of confounders that would be a problem. The types that would be a problem are where the local demand is correlated with in the destination, the place you're interested in, is correlated with demand at the origin. That to us is the most serious type of confounder that we had to deal with. Okay, so now I'm going to sort of try to show you some numbers. So we first, as I mentioned, in step one, we tried to estimate these pass-through rates. using the equation I talked about earlier, the key restriction here is going to be to require that whatever it is that's determining the origin price and shocks to the origin price is orthogonal to unobserved demand shifters at the destination. So to me, the most convincing thing we're able to do to assess the plausibility of that assumption was to kind of see how our results changed as we considered regions increasingly far away from the origin location. So you might imagine that if demand shocks are spatially correlated, then your results would be more biased with a proximate sample than a distant sample, and yet the fact that the coefficients don't appear to change over the proximate versus distance was to me reassuring. So we estimate all these pass-through rates, and they look like this. And Tim asked me which of these is our favorite, our preferred, which is your preferred estimate. It's like asking which is my preferred child. They're all, each of them is an estimate of the pass-through in a product and a destination. So this is not a theory that's attempting to have a theory of where pass-through comes from. That would be a theory that would try to take a stand on why there's so much spread or something. This is a theory of, this is an empirical exercise that's trying to say, well, whatever it is the data is revealing for us in a sufficient statistic way, the fundamentals that are embedded in that pass-through rate. So nevertheless, you'll see some tendencies. They tend to be less than 1. There's no theory that suggests that's true, but that's consistent with most other estimates in the literature. They tend to be positive. That's a good thing, that pass-through shouldn't really ever be negative. But of course, there's no guarantee that they're negative, as you can see, or that they're positive, as you can see. They tend to be weakly declining, at least if you trust these kinds of estimators, locally weighted polynomial. But then that might be consistent with your priors, that remote locations away from the factory town have less entry, less competition, so lower pass-through. That might be consistent with what you'd expect. Okay, but whatever those pass-through estimates are, as I said, they're just a sort of tool for us to then stick into step 2, which I've already mentioned looks like this. That is, we're going to sort of try to develop these pass-through adjusted price gaps and regress those on functions of x. And the theory tells us that if we can control for this stuff, that should be identifying tau events. So we do a whole bunch of robustness in the paper, and of course the important point is that in sort of sense you want to explore robustness both on the pass-through estimate, step 1, and also on step 2. They're intertwined. So there's no way to separate them. You make assumptions that deliver you a pass-through estimate, and that affects your step 2 estimates. So you kind of have to do the two in tandem. Okay, so but when you stick all that into the machinery I told you about, you arrive at estimates that I presented in the introduction. Now with confidence intervals, these are bootstrapped to deal with the obvious serial correlation in this data and generating regressor problems. These are now kind of statements like I made earlier, but with confidence intervals along the lines of this slope is quite steep relatively steep in Ethiopia and Nigeria, and quite a bit less steep in the US, but always statistically different from 0, statistically different from the methods you'd get if you were doing it the wrong way, if you like, the way that the data appears to be rejecting. I should have said that, of course, if the data had said these things were all 1, then our price correction would not matter. You'd stick a bunch of 1s into this, and it would just reveal the normal price gap, and that would mean that the blue lines here, the dark blue lines, are the same as the light blue lines here. And as you can kind of see, they're not. Okay.
Let's start a roll.
Thanks. Okay, so I will just conclude. As I mentioned in the introduction, there's a bunch of other things that we're trying to do in the paper. I've shown you, in a sense, the first, the most important chunk, which is this question of how large are these costs in a place like Ethiopia and Nigeria relative to the US? And our preferred estimates, here we do have preferred estimates, because this is the tau function, that's something that we're really, we do have a theory of, we're trying to get right, is that's sort of in the order of 4 or 5 times larger than in the US. And as I mentioned, that's consistent with outside engineering estimates in the very limited sense where those have been done, which to us was somewhat reassuring. The thing I didn't have time to talk about was the implications for the incidence of globalization, but if you know Glenn and Mikhail's work on that, you kind of know the punchline. If the pass-through is not 1, then of course the incidence will be somewhat pro-producer, and the fact that the pass-through appears to be on average somewhat falling over space tells us that incidence, all else equal, and our estimates suggest that all else roughly is equal, that incidence is increasingly pro-producer as you go to increasingly remote locations. So that's the punchline of that exercise that I didn't have time to say more about. And as just a final word, I want to stress that what we think is the sort of novel element of this is that this is exploiting the sufficient statistic argument, that the lack of the need to do this, but without the need to specify all of the supply and the demand sides of the economy, but only using price data, and that's motivated by the fact that we're interested in policy environments where getting good quantity and price data at the barcode level is just not going to happen anytime soon, and so price data is what we have. So thanks for your time also.
Very good, thanks. Super interesting and novel form of conference. I get to discuss the paper of someone I see every morning before 8 o'clock. I interpret that as Chicago colonizing Stanford. And therefore, I immediately counterattack. Brief editorial. So here's from Mo Abramowitz's book, note the title, Price Theory. And I put this up for two reasons. One is note that Mo points out that the things Dave was successful in today are impossible. We've made an enormous amount of progress since 1939. The second thing is I would say, maybe I have a slightly narrower definition of the phrase price theory than Glenn does, but most of that progress came from sort of elbowing aside price theory and letting in a little room for the theory of games. Okay, so there's the end of the editorial. There's two big accomplishments in this really interesting paper. One of them is finding these price wedges and pinning them on the OD trading pairs and to some degree on distance. And I think that's a bigger accomplishment than Dave told us about. It took a lot of work, real research work. And then whether you think that these price wages come from social costs, the tau, or they come from something else that these remote consumers can't escape, the mu, they're a problem for the remote consumer. So that has, as David pointed out, large implications for the benefits to the comparatively remote LDC consumers. If those costs, if these intermediaries, and these intermediaries are everybody, they're retail trade, they're the bribe-taking policemen, they're the trucking system, they're the infrastructure, these intermediaries are everybody. If those costs also apply in the other direction, they're also a block to supply coming out from these remote locations. And there's lots of other times when places have industrialized. Think of England industrializing and industrializing remote locations first, right? So that might be efficient. We know that in lots of LDCs, there's mass migration to poverty in the big cities, right? Same thing. If there's a tax on remote production as well as on remote consumption because these transportation difficulties are symmetric, that's the thing. So I think this might be even bigger than they say. The second part, which is dividing the price wedges into social costs, here called trade costs, and into the intermediaries markup. First off, I agree with Dave that if you're thinking about either cracking down on the bribes only, or on building out the infrastructure only, rather than both, you do need to tell those apart. So that's a good research thing. This is a harder question, and I'm basically going to have 3 suggestions for making it sharper, which are going to appear approximately in the range of can do right now and it will work, could do right now and it probably won't work, and the future of this very interesting literature which these guys have opened up. So I'm going to skip my agreement with them because Dave did a really good job on it. To do everything I want to do, I only need a tiny bit more general model than the one Dave showed. That the two differences are going to be, I'm not going to difference it. He differenced it in location, and I'm not going to difference it. And I'm going to let marginal costs be rising. I'm going to let the tau function depend on quantity. I'm going to let there be rising retail marginal costs. That's all I'm going to need. And then the first big thing, what about measurement error in the P0? One of the really good ideas of this paper There's a lot of really good ideas in the paper. One of these really good ideas in this paper is to use the comparative statics of prices in landed cost to get at the comparative statics of prices in like transportation cost. And those ought to be the same. We use P0 as a proxy for landed cost if it's an import. That's a really good idea. But there might be measurement error. Okay, so first, let me say I have a small point here. You know, and it's griping about the Ethiopian data is a mug's game, I think. The paper uses extremely fixed commodity, but of course the consumer price index also depends on retail services. I know nothing about Ethiopia or Nigeria. Everything I learned from the paper is that the retail services are lower quality in the periphery and the Ds than they are in the O. There's less variety and there's less inventory. So that would mean that the price gaps are bigger. So this is one of this, I would tend to agree with you things. More seriously, suppose there's at O, right? O is not the factory gate. O is not the stuff coming off the boat. O is retail transactions near there. Suppose there's supply and demand at O. So any cost shocks at O to retail trade are measurement error for these estimates. If the supply curve at O is upward sloping, either because marginal cost is upward sloping, you know, there's heterogeneity in the talent of the available entrepreneurial retailers, or there's capacity constraints in the less entrepreneurial retailers. Then, so if the supply curve, short-run supply curve is sloping up at O, then local demand errors will be in PO2. And that gives measurement error for PO being a proxy for costs, for landed costs. I think that this is, so that could be whether it's rising marginal cost or downward sloping marginal revenue in local retail at O. Either one gives this problem. So it seems like there are two solutions you can do it. This is a very internationally tradey kind of paper. You know, the first one is and I bet this works for the domestic producers as well as for the importers. You know, movements in exchange rates or generally movements in out-of-country prices are terrific instruments. They ought to hit the landed cost and not hit the local supply and demand at the O. So that's, then the other one is, I think, and Dave showed us the beginning of they're already going down this path. We have repeated observations on every PO. And if every PO has, you know, with multiple Ds. So you could use ordinary classical, and they've already started to think about what's correlated with what. Suppose you looked at Ds that are out different directions. They're going to be less correlated. You could look at second moments of prices to get something along this way. Do I think this is a serious problem? Yeah, they get 75% even in the United States, you know. And it can't, you know, I mean, I'm probably on the outer left of thinking there's a lot of market power in the manufacturing of the United States, but no, it's not that big. Second one, fully admitted by the authors, but relevant, flat marginal cost. Flat marginal cost here has to be in everything. Transportation, commercial disciplines, bribe taping, that one seems innocent, and retail trade. They channel, calling it a sufficient statistic argument, the Panzer and Ross argument that you can get pass through and therefore market power by the comparative statics of price in cost. That, of course, requires flat marginal cost as an assumption. Rising marginal cost in any of the places will break that, right? There's two ways to do that. One is, you know, it's an economic argument, which I made a long time ago. You pass through can come from either the slope of MC, get passed through even in perfect competition, or the slope of MR, marginal revenue. That's the economic argument. The other one, the econometric argument, you know, You use a supply side shifter to learn something about supply. Markups pass through all that. That's a supply behavior. You know you're going to have to be using really super strong assumptions. These are just the same two arguments in different language. So here too, how do you feel about rising marginal costs? Here's a paper about building out new infrastructure, right? This right here, this picture exhausts my entire empirical knowledge of Ethiopia. If you're thinking about building about infrastructure, you're not thinking about shifting a flat marginal cost curve down. You're thinking about shifting a rising marginal cost curve out. That's what building infrastructure means. So I think it's, in the context of this paper, serious to worry about rising marginal cost. What could you do? The paper sort of started to go down this path by working on horizontal market structure a little bit to try and pin more on market power. And the two ones, anybody I've ever met in the transportation business has invented some version of value of service pricing. I don't know how good that's going to do here. This stuff here is kind of between half $1 and $1, but $1 might be a lot of money in Nigeria. And then the other one is there are lots of estimates of the demand elasticity for everything out there. They come from countries where there's much better data. So you could do a better job of this. And that would get the incidence stuff at the end, which, by the way, I don't think the incidence stuff is strictly necessary for this being a really interesting paper, but you'd like to have a better job of the incidence. And the more you can pin these markups on market power, the more you can pin the estimates of tau on being social costs. To the extent that's important, and that would speak to the infrastructure issue. So that one, I think this paper, look, there's no quantity data. There's not going to be any demand elasticities. It's got to work with tricks like this, but something like this could be done. And then to go outside this paper, I think, and think about where this whole discussion might go, I'd have a third one, which is throughout the other maintained assumption of this paper is that the intermediary is a unified, internally efficient entity. Who's in this entity? It's the distributing wholesalers, it's the trucking companies, it's the bribe-taking officials, and it's the retailers. So it's an extremely efficient kleptocracy, right? I mean, it's documented that it's a big kleptocracy. We have these gigantic cost differences. If they were not vertically integrated, or if they could not incorporate the kinds of contracts which give one another efficient incentives, then you're going to get double, triple, multiple marginalization. And that has two implications. One is, I think, that might just be in agreement with this paper. We're finding these gigantic wedges, maybe a lot for one kind of bad actor, but a string of vertically disintegrated bad actors could push that up a long way. The other one is, I think, harder for this paper. It's harder for the tau identifying thing, right? Which is the iterated monopoly model implies that they're different markups over different costs elements. So that's this is opening a whole new door into a much bigger thing. But this question about how internally well organized is the Ethiopian kleptocracy seems very interesting to me. And I just sort of want to remind, I keep thinking of these earlier development examples. The iterated monopoly model was invented to deal with exactly this problem. Right? Before the formation of the Rhine League, the toll charging castles along the Rhine charge significantly more than the toll. So and that might be right here. I don't know. Who's getting a bribe here, how efficient their contract with the trucking guys and all that kind of stuff. I think this is really an interesting opening for the future. But all this is just to say, the paper's open a really interesting box.
You're looking at the pass-through rate of changes in T0, which is a common element of cost, whereas what you're really interested in is the pass-through rate of differential costs across locations. So if there's competition across locations, that really, those two pass-through rates really wouldn't be the same, because it depends on who else's costs are going up. And this also speaks to Tim's idea of using the instruments of exchange rates, for which you would think the pass-through rates wouldn't be the same, because you're changing the cost of lots of commodities, not just the commodities in question. So the other side, I would say, I would worry about is multi-product sellers, that the competition-inducing effects don't always just get limited to the products in question. So it's hard to even measure the impact on the ultimate consumers of just this one product changing, because if people are entering or leaving in response to these changes, those often get spread out over lots of commodities. So even though the pass-through rate of a cost reduction might be less than 1 on this commodity, doesn't mean if you measured it market-wide across all the products sold by a multi-product retailer, it might be a lot different. So it's very, I think in a multi-product retailer context, interpreting pass-through rates is even more problematic, because the pass-through isn't always limited to the good in question, particularly when you think about welfare effects. So those would be 2 of my comments. I think you got to think about differential pass-through for different experiments, which in your example might be different for P0 changes and slope changes, which is ultimately what you're interested in. Or it's different when everybody's costs are going up versus my costs are going up relative to another one if there was some kind of spatial competition. So,
yeah.
All right, so. Go ahead, you can answer.
So with respect to the first point, I mean, of course you make a very good one. I think it has different flavors. I mean, one is that just to avoid any possible confusion, we do let the data speak to there being a different, completely unrestrictedly different pass-through rate at location 1 from location 2. So that captures, of course, the first order thing, that those might just be completely different competitive environments. But I think a second part of your point was that some of these shocks we're using might be identifying off of cases where, in a world where location
are changing, other ones relative costs.
Well, everything I said today, location 1 and location 2 were assumed to be non-interacting economies, except for of course the fact they happen to just both buy from location O. So you're highlighting a whole important class of problems where if people could buy cheap and buy from O, but then buy that gets something sold in 2, a very competitive place, and then person from location 1 goes to location 2 and buys there and takes it back to location 1. So that kind of a cross-destination market arbitrage, I agree, is in principle a problem. We think that the magnitude of those kinds of rents in this sort of environment aren't enormous. Like those, given the road network and stuff, when we actually stick it into our data, we don't see huge opportunities there, but it doesn't mean that it couldn't be happening. I think you said another smart thing, which is that just the shock in itself might shock some other cost. That means that we're not just seeing one cost shock, we're seeing the sum of that cost shock plus a correlated cost shock. That's a very important point. That motivates some of the exercises that we do in some of the robustness checks in the paper. Multi-product sellers is another excellent point, of course. We've explored, robustness to different types of fixed effects that we thought would explore that type of variation. So that is, since we have so many different products, we can control for stuff that's common to a given destination. In Nigeria, the data comes with a fixed effect for the given retail establishment at which that month that particular type of cigarette was found. So we can include kind of establishment fixed effects and that sort of thing. That's discussed in the paper, and our results don't appear to be sensitive to that. There are different decisions about that sort of which type of variation were exploited, which to me suggested that this sort of thing might not be first order. But I totally agree that at a level of theory, I mean a multi-product firm is very different from a bunch of independent single product firms. Happy to. So Tim, one thing you mentioned was, the whole cluster of stuff that you've given me lots of things to think about, and I'll talk to you about that at home. But one thing I should mention is there's a class of things you were suggesting that we started to scrape away at, which is sort of in class of like, do these pass-through estimates make sense? From some, I kind of took a bit of a caricature view where it's almost like we don't care. Of course, we don't really think that. It's just that from the strict sufficient angle, if you believe these pass-through estimates, you shouldn't care. But of course, you should ask the question, well, are they believable, the estimates themselves? So we started to explore that sort of thing. One thing that's reassuring is that they're relatively homogeneous within location across product, which might be consistent with your priors. That product kind of specific component of pass-through, when you use theory to try to extract the component of the pass-through rate that has to do with the competitiveness environment, that requires one additional assumption which I don't have time to go into, but that delivers something sensible that we discuss in the paper, which is that competitiveness environment correlates well with things you might expect to be correlated with how competitive an environment is, such as market size or number of retail establishments in a location. So that there's a little bit of sort of outside evidence. One thing we haven't explored is the things you were writing about using outside estimates of demand parameters to ask whether these estimates of, if you believe pass-through, it should be saying something about demand, and that's testable if you have some outside estimate of demand. So that's something we haven't done, but we should think hard over.
All of that heterogeneity in those scatter plots and the estimated pass-through rates, that's just raw estimates unadjusted for sampling variation?
That's right, yeah.
So how much does that shrink if we adjust for the, presumably a lot of those coefficients have just standard errors.
Huge standard errors, yeah, absolutely.
So what do we think we learned about the true heterogeneity in pass-through rates?
Good question. We haven't thought about that question. We've just been worried about, since pass-through is just a tool for us to try to stick it into step 2, we were more interested in how our step 2 estimates biased or imprecise by the sample variation in the pass-through estimates. And that motivated some of the the small sample corrections we discussed in the paper, and also the approach to bootstrapping the standard errors, clustering very conservative, we thought, in those final confidence interval plots I showed. But a good question you're asking that I don't have the answer to is kind of what do we know about the precision with which we any given pass through estimate.
Along the line, Tim was saying, looking at what those covary with, they look sensible. Does the variation in those things look sensible?
Yeah,
Seems really helpful. And the first step in doing that would be to just shrink them so we have something like individual estimates whose variance has meaning.
Yeah, so just because each one is identified off of 10 years of monthly data, so it's sort of, they're all, as you can imagine, they're all very noisy.
I think Matt just wants you to decompose the variance and the estimates into the sampling variance and variance in the true underlying parameters.
Your estimate is sampling variance, your estimate is the true underlying.
Sure, yeah.
Now, probably should move on to our next paper.